Hi there. If you are planning to invest in Tilray brands, you must know this important thing because you have a high risk with this company. As you can see, the stock price year to date is down 22%. Of course, in the meantime, the stock price went up to $2.80 from $1.60, an increase over 60%, almost 70%. That's great. But then you see what happened. The stock price got back, a decline over 40%. But if you look at the whole picture, you can see that year to date the stock price is down over 20%. And if you look at a longer period, you can see this massive decline over 96%. And this is quite bad because maybe you had invested at the beginning of 2021. Here, when the stock price was about $8. And then you had an increase over 180% and you said that this will go to the moon, but then your performance got worse and worse. As you can see, a decline over 80%. And this happened because of dilution. As you can see here, the number of shares from 2021, here, 2021, they had about 260 million shares. But then those shares went up. They've continued to issue more shares to over 750 million. And when the number of shares doubles from 260 million to 500, almost 600, you have a decrease in the stock price of over 50%. And you already see the results. Then, as this company continues to issue more shares, if they double the number of shares from 500 million to 1 billion, so they are almost there, then you have another 50% decline in the stock price. And that's why you have this performance, bad performance. The stock price went from $40 to $1.70. And let me show you why I think that they will continue to issue more shares. So you've seen the results. If you look at the last quarter, you can easily see the increase in the number of shares. Here, the average number of common shares. Last quarter, February 2024, they had 754 million. And year over year, the previous year, 2023, they had 615 million. So you can easily see the increase in the number of shares, which is quite high. And by the way, this is not all. If you read their files, you can see that on April 24th, they entered into a private debt for equity exchange transactions. This means the company expects to issue up to 15 million shares of the company, common stock, in exchange for 24 million of their debt. So, as they have so much debt on their balance sheet, you can see here, if you add all their debt is over 400 million, long-term debt over 165 million, convertible 126 million, then bank indebtedness 15 million, current portion of long-term debt 12 million, and current portion of convertible debentures of over 80 million. If you add all those numbers, the debt is over 400 million. Of course, they also have some cash of about 220 million, but they still have a lot of debt. And to get rid of that debt, they started to issue more shares. Now, this is great for their management because they will have less debt. And maybe if the stock price, the market cap stay high, over 1 billion, they'll be able to issue more shares and do more acquisitions, but at the expense of investors, current shareholders, because they get this massive decline, this massive dilution. And as I said, they announced in April 24th, they'll issue another 15 million. This is not that much compared to the number of shares, which are over 700 million. But then, if you read the following reports, the following files, you can see that on May 13th, they announced that they'll issue another 13 million shares. And then on May 17th, they announced that the company may offer and sell shares of the company common stock having an offering price of up to 250 million. 250 million. Now, if you look at this value, 250 million, and compare to the current market cap of 1.4 billion, maybe in May the value was even higher. Let's do back. In May the stock price was about $2. So the market cap was higher than 1.4 billion. But let's say the market cap is 1.4 billion. And if they issue, as they announced, another 250 million worth of common shares, that will mean a 17% of the current market cap. And that's a lot. 17% of the current market cap. This means another decline over 20% in the stock price in the long term. Moreover, if they continue this way, the stock price will go down even more. It may go down to $1 and less than that. And then they have to do a reverse stock split so that can be traded on the Nasdaq. And that's why you have to be aware of this massive dilution. You can easily see here the number of shares. From 2021, they had over 200 million and now over 700 million, close to 1 billion. And this is bad, the highest risk for investors. Yes, if you look at the estimates, the analyst estimates, you can see that the revenue is expected to grow more in the future from 600 million to 1.3 billion. And they also expect that this company, Tilray, will become profitable. They will report a profit of 60 million. Now, they might grow the revenue more in the future because if you look at the last quarter results, you can see the revenue has increased. Year over year, an increase from 145 million to 188 million. So the revenue has increased. But at the expense of shareholders, current shareholders. They issue more shares, they do more acquisitions with the money they get, but they're not becoming profitable. And this is a huge risk for you, especially if you are a shareholder or you plan to invest in this company. That's why the risk is quite high. Yes, they have more opportunities, presence in the US, Canada, and Europe, and other countries around the world. They have more brands. By the way, this cannabis market is expected to grow by 44% compound annual growth rate from 2023 by 2030. This is great. They might also expand in other countries, international, and they'll do more acquisitions. But the highest risk, as I said, is dilution. As you've seen, the number of shares went up a lot, and they're planning to issue more shares. They might not become profitable, because if you look at the past, their gross profit were about the same, over 100 million. And on top of that, you add their expenses, you have these huge losses. And if they no longer have the possibility to issue more shares, because the market cap will get lower and lower, then the higher risk is that the company may go bankrupt. Of course, for the moment, they are doing quite great. As the market cap is over 1 billion, they can issue more shares and get more money from investors, from the public, to invest in their business, to do new acquisitions. But this is bad for shareholders, because they will get diluted. As I said, the number of shares keeps going up, and the stock price does the opposite, keeps going down. And this is the highest risk. You have to be aware of this company. Yes, in the short term, you can have these ups and downs. An increase over 70% in just a few days, but then a decline over 30%. So you have to be aware of the risk if you are planning to invest in this company. Maybe you like their products, what they do, but also be aware of the risk. Because if you invest at the wrong time, you have this decline. Year to date, over 22%, and over the last 5 years, a huge decline over 96%. And you don't want that. You want to avoid this massive decline. So that's it for this video. And if you have other questions about this company or other things, then let me know in the comments.